You can't hear us now. Hi, everyone. Well, just give us a minute while we get our cameras rolling. There we go. Smooth as silk.
Absolutely.
Welcome to the 262 Market Report. I'm Jennifer Zoeller, the Red Shoe Realtor. I'm here with TJ Ebert, Guidance Mortgage. He's joining us again, and we're going to talk about first-time homeowners, first-time buyers, and the loans that are available, the products. How have you been, TJ?
Doing good. I'm doing good. It's another interesting time as it relates to the market and the world of finance, but all in all good. It's the start of March Madness. It's a great time.
It's never boring, is it? So let's talk about this week. A couple big things happened. Some related, directly to mortgage rates. Some related to the whole environment of finances. Let's talk about the banking, SVP Bank.
Yeah, Silicon Valley.
Yeah, what do you think?
Well, it's kind of shaken the economy and the mortgage industry a little bit because it is giving some signs, some allusions to what took place back in 2008. But it was I believe the third largest bank to have failed in the U.S. So it's significant enough that the Fed had to step in. And I am by no means an expert when it comes to federal banking regulations and large banks, how they operate. But the federal government had to step in, and FDIC insure the deposits up to $250,000 for account holders there. And there have been some trickle effects or some other financials that are at risk or on watch of failure. I know just today or yesterday there was Credit Suisse.
Yeah, I saw that
over
too.
In Europe, that is on shaky ground. I think I just got an alert that there's now a Lifeline investor that's swooping in to salvage Credit Suisse, but there's a lot of uncertainty.
There is? I didn't see that.
A lot of uncertainty right now.
And it seems like at first, Monday or Sunday night, when the president came in and he said, we're going to make depositors whole, investors not, it kind of steadied a little bit, what happened. Although then, Tuesday, 30 more banks where they shut down trading and that. So how's that affected mortgage rates, along with everything else? Because what reports came out this week already?
So this week was the big one, CPI. So inflation, it shows the month-over-month inflation numbers as well as the year-over-year inflation numbers. And the inflation numbers were really in line with what was forecasted. However, that was overshadowed by the banking, SVB, and other trickle effect kind of overshadowed those reports. So while the inflation was in line with expectation, it hasn't had we haven't been able to decipher what the impact on rates because of the other major things that have happened.
Yeah, there's so many factors coming together, right, that it's hard to get a clear picture of what needs to be done. And I think for a while people were thinking next week, is that right, that the Fed was going to go 0.5, but
yes.
Now do you think it might be a little less because of all this?
Before, so it was a week ago, just after Fed Chair Powell met with both branches of the government, there was a 80% expectation that there would be a 50 basis point hike in rates on the 22nd, so next week, Wednesday. And now come Monday morning after the SVP collapse, that was down to 25% likelihood of a 25% likelihood of a 50 point hike. So
dropped
now
a lot.
with the additional items, it seems that anything other than a 25-point hike is unexpected.
And then it's so funny, before this banking on Friday, it was almost, given, yep, it's going to be 50. Mm-hmm. And I think it's a good indicator of not assuming anything, even a week out or 2 weeks out. I was so happy so rates dropped a little bit this week, right? And I had a client who locked in at 6.5, which they weren't expecting. So they timed it perfectly. Mm-hmm. So how are you seeing mortgage applications? Are your applications getting homes? What are you seeing?
Yeah, so there's from a month ago when I was here, there was a little bit more activity in terms of interest in pre-approval conversations, and there's still a shortage of inventory that we spoke of. And so I have one particular buyer that has offered on 4 homes in the last 3 weeks, and their offer has not been It's a very competitive offer. They're well positioned. However, they there's not enough homes to go around, so they're getting outbid by people who are going way above asking price. And that's for this price point. It's not across the board at all price points.
And I think I see that too. And like, you know, when you're trying to write an offer as an agent, like, is this going to do it? Like, this is a really strong offer, but you never know who's like done looking, that they're just going to write the offer to like, I want the house, I'm going to go whatever over. And so you never know like who you're going against. And so you just have to write that offer that if you lose it $1 over, you're good with it. I know I've had a couple clients, like it's kind of a roller coaster for my clients right now, especially my first time buyers who have not been in the game, and the game is so different right now. They had a couple, not accepted offers last week, and Sunday they're like, okay, we're done. And then like Monday around noon, they sent me over a house. I was like, yes, just because I think it's good not to take yourself out of the game. It really ties into what we talked to last month about, the money that you put in and that you get involved, get home ownership now and the long-term effect. So, and we got an accepted offer on Monday. Right. I know, I was really happy. So that really ties into our discussion today. We want to talk about first-time buyers and the products out there. And so what are the common misconceptions so there's a product out there for FHA, first-time home. What does FHA stand for?
Federal Housing Administration.
Thank you.
Yeah, so it's a federally backed mortgage product.
Okay. And now what are some of the misconceptions? I feel like there's a lot of misconceptions about those.
Well, one of the big ones is that it is only for low income borrowers. However, an FHA loan has no income limitations whatsoever. Conversely, I think sometimes people get it mixed or align it with a WIDA product, which is designed. There are income maximums with WIDA products. For an FHA loan, there's nothing as tied to how somebody could earn too much money to qualify for income. So that's a big one. Another one is that it's only for first-time home buyers. That's not the case. It is taken advantage of a lot of times by first-time home buyers because of some benefits that it can provide for those buyers, but there's not a requirement at all. It's not designated just for first-time buyers. So like there's no top number that they couldn't, that they earn that they couldn't use the FHA. Correct.
Oh, and then again, and I think there's a lot of, and I know before I was an agent, this was my misconception too, like first-time homeowners only. So what are some of the qualifications? Why would somebody choose the FHA product?
Well, one of the big differences between an FHA loan product and a conventional mortgage is how much it's going to require as a down payment. Where a conventional loan product typically requires 5% or more as a down payment, an FHA only requires 3.5% as that down payment. So that's where a lot of times it's the first-time buyer that is taking advantage of that, because it can be a $300,000 home that's almost $5,000 less that would have to be paid as a down payment.
Right. And is that because it's backed by the federal government that you can do the lower rates, or?
Yes, because it's insured and backed by federal government, there's less of a risk to the investors and the banks who ultimately will hold that mortgage in their portfolio, or put it off into the market. So there's less risk tied to it. So that's why there is a little bit more advantages and flexibility when it comes to it.
So let's talk about how is it different than, let's say, a conventional loan. Why would somebody choose FHA and conventional, or would somebody who would qualify for a conventional choose an FHA?
Yeah, it's that to the last part there. It's definitely not something where a buyer goes with an FHA because they cannot qualify for a conventional. That may be the case, but that's not a true or false situation. Somebody could very well qualify for a conventional loan, and an FHA loan would make more sense for them. The three most common factors that would go into somebody where an FHA loan would benefit them more would be if they don't have a high credit score, if they don't have a large down payment amount, they can't reach that 5%, or their monthly obligations compared to their monthly income, so that all important, the debt to income ratio, maybe their ratios are a little bit higher, and so a conventional loan is going to be more costly, or maybe they can't get it because their DTI is so high, But an FHA loan has more flexibility. You can go to a higher DTI with an FHA loan than you can with a conventional. And where there are instances where somebody cannot qualify for a conventional, and therefore an FHA loan is their option, that situation might be with credit score. So one difference between a conventional and FHA is the minimum credit scores. A conventional loan, typically it's 620 or higher. In reality, 660 or higher to get better interest rate pricing. But an FHA loan has kind of two tiers. One is anything a score 580 or higher is going to qualify for the traditional benefits, the lower down payment, 3.5% requirement. However, it's possible that someone could have a credit score all the way down to 500 and still qualify for an FHA loan. There are different factors in terms of they have to put more as a down payment, and there may have to be other benefits to the buyer, to the borrower in that situation, but potentially all the way down to 500 with an FHA loan.
You know, it makes me think, like, being divorced myself, like, I could really see how an FHA loan is great for somebody who's maybe coming out of divorce, and maybe that wreaked havoc on your credit, or maybe your expenses are higher because now you're divorced and have more expenses. And so I could see where that would be a really great product for. That's, one situation that I hear. Or, like, you have kids going to college, you have these other, expenses, so much income going out. So they're really, it's a nice product that it's not, that it can really help people in a different, just life transitions.
Yes.
That your credit score has dropped for whatever reason.
Mm-hmm.
Now, is the rate higher on FHA loan than a conventional?
It's usually, it might be slightly higher than a conventional. However, it's all dependent upon multiple factors. So it's priced, the interest rate is similarly factored, just like a conventional, based on your income, based on the loan amount, your credit score, how much of a down payment you're applying to the loan. So there are a lot of factors that go into it, just like a conventional loan. Okay. So interest rates are usually comparable depending upon market conditions and those other factors I mentioned. Maybe it's a hair better interest rate, maybe it's a touch higher. However, the benefit of having a lesser down payment or lower monthly insurance on the monthly mortgage insurance can far outpace the difference in interest rate on there. And another like misconception or something that we want to make sure to share with an FHA loan is it doesn't have to be a long-term mortgage solution. It can be a getting the foot in the door. You have a lot of expenses, as Jennifer mentioned. You have kids in college, whatever it might be. One FHA loan can get that home for you, get that mortgage set up, get you in a position so that a year, 2, 3, 4 years down the line, when your income is higher, credit's higher, you can refinance into a conventional loan and move into that product.
Again, that's talking like what we talked about last week, like using the FHA to get yourself, to start building that equity in year 1, 2, and 3 instead of waiting till you could qualify for a conventional. So, like, what are, as far as a first-time home buyer, because people think this is their, that is for first-time, although it's for everyone. What are the benefits for a first-time homeowner then? Is it kind of what we talked about, the lower down payment? There are other reasons?
That really is lower down payment. Is the biggest one, especially when it comes to a duplex or multifamily. So a duplex, for somebody who wants to buy it with a conventional loan on a duplex, would need to put 15% down, whereas they could still do 3.5% on an FHA duplex. So that is another benefit there. But it's really also could be someone who has lesser credit history. Doesn't have years of car loans, credit cards, previous mortgage on there. That there are ways to be able to leverage non-traditional type of credit situations where we might be able to leverage a utilities payment. Someone's renting, they have monthly utilities payment or internet bill. That the paying rent then itself. It could be paying insurance, those sorts of things we can look to build in and bolster that credit file, credit report history, whereas those things cannot be factored in for a conventional loan.
So that's where it's important to talk to lenders that are creative and, with first-time buyers, FHA, that, know the things that they can do to bolster, to get you in that home, build your credit file. So is it changed by locations at all, FHA loans? Like, is it like suburban, urban, rural, or different states, or is it pretty uniform?
Yeah, so the one difference between FHA and conventional is a loan limit. So the maximum amount you could borrow in that loan program. Where a conventional loan, anything single family home, we'll use Wisconsin as an example, single family home in Wisconsin, you can go up to $726,200 in a loan and still get the conventional mortgage interest rate pricing and product. An FHA single family, the limit is about $472,000 in that loan. So it's not designed for lower income. However, it does have lower loan limit options there. And to your question about does it change place to place throughout the area, it's classified by there's a standard rate, and then there are elevated rates if it's labeled a higher cost living center. So using the state of Wisconsin, the loan limits are always county specific. And the entire state of Wisconsin has the same limits except for two. And there are two counties over just across near the Twin Cities. So it's St. Croix County and Pierce County, where those limits are 9% higher than everywhere else simply because it's designated as a higher cost of living area.
So interesting. If you had made me pick, those are not the two counties I would pick. I wonder why cost of living is higher there. Is it because it's close to the Twin Cities?
I think it's just the cities. There must be enough people that work in the cities.
Interesting.
But live over there, yeah.
And so just so I understand what you were saying too, so if somebody's going to buy a house that's $550, they need a loan of $550. Let's say they need a loan of $550. They're going conventional.
Correct.
Okay, let's say they were going to, no, because it wouldn't matter if they were going to put that much down. But if they were going to do like $490, but they were going to put the 3% down. That doesn't quite get you. It does.
It'd be close, but ultimately it's an ending loan amount. So if the loan amount on a single family is $472 or less, then it would be eligible for an FHA loan.
Okay.
And going back to the duplex, so it's tiered based on single family or 1 unit, and then 2 unit, 3 unit, 4 unit. So a duplex limit is higher. It's about $130,000 more at $604,000. So that puts in the wheelhouse of somebody looking to buy a duplex. They could very likely, I should say, utilize FHA financing.
Okay. And how long is the length that it takes to close different on an FHA than a conventional?
It doesn't have to be. I'll say that it's likely the industry average is longer on an FHA loan than conventional. However, that's taking into account the larger banks, maybe it's a .com bank, that may have more, less flexibility, less agility to work with that. However, for me and my company, Guidance Mortgage, it doesn't have to be much longer than a conventional mortgage. Where conventional mortgage loan, we could get closed within 30 days, well within our wheelhouse. We can do that same thing on an FHA, so long as it takes two to tango. To make it that efficient, we can move as quickly as the people we're working with. So it does a lot of times require the cooperation and efficiency from the buyer's side, just like it would a conventional. So I would say that for me and my company, the timelines don't have to be different between FHA and conventional.
So let's talk about that. So you get an accepted offer, FHA. The agent emails your lender, here's our accepted offer, then what happens?
So a lot of times it's not different than a conventional, but the big thing is ordering an appraisal. An FHA can possibly slow a process down if there are things that are uncovered with an appraisal that require fixes or repairs. FHA, because it has a federal backing to it, and also taking advantage of getting better pricing, there's less risk because they know that the appraiser has identified that there's next to nothing wrong with this house. So when I say next to nothing wrong, it doesn't mean that it has to be walk-in turnkey, everything is good, but an appraisal requirement is different than a conventional by way of if there is any peeling paint or any missing handrails, or maybe there's a cracked window, could be missing shingle, whatever that could be. It could be that a sink isn't operational. Those sorts of things on a conventional appraisal, conventional loan, no issue whatsoever. That's between the buyer and the seller. On an FHA, the government wants to make sure that the house is livable, that the home has solid value. So those things would need to be fixed prior to being able to have that appraisal signed off on. So that can delay the process. But that's only, a lot of times we can identify that looking at pictures of a listing and see, oh, there's a missing handrail. Oh, I can see paint. I can see missing outlet covers. Those things we can identify and go into it knowing, all right, we're probably going to have some repairs done. Maybe we can't do a 30-day close here.
I think, like, in talking about misconceptions earlier, I think this is like the seller's misconception, right? Like, they're like, oh no, FHA, I'm going to do all these ticky-tacky little things before we close. And like, what do you see in FHA appraisals? Like, how often are there really significant things that have to get taken care of before close? What are those things when they're big?
Yeah, the big ones are not that common. The ones that I would maybe put in that big category would be is if there are any noticeable, like visually you can see there's something not right with a roof. Mm-hmm. Might mean there's some leaking going on somewhere. That would need to be fixed. It could be maybe the seller was in the middle of a remodel and they are waiting to finish. Maybe it's a bathroom that they haven't finished the flooring. Well, if there's any flooring that is missing, that would not pass the appraisal. So I guess to sum it up, you wouldn't want to leverage it for a fixer-upper type of home.
Right.
You'd want it has to be a livable home, that there's nothing unsafe or unsanitary about the home.
And do you have, I don't know, something you say made me thought of this question, and it's sort of from the earlier thing. Do people ever who are buying, do they ever put more than 20% down and still use an FHA? Or would they not do that because, the different requirements, like, the home repair and that? Or do people use that solution at all?
Most likely it's not going to make sense. If someone's in a position to put 20% down, it's not going to make sense to go FHA. And unless there's low credit or the debt to income, the cash flow is tight, if those two things aren't an issue, then it would be very unlikely someone's going to choose an FHA, because an FHA always has a mortgage insurance premium, no matter the LTV, no matter what the proportion of the loan is to the home's value. Whereas a conventional loan, as long as that loan to value does not exceed 80%, there is not mortgage insurance. So I'm not going to say it's never going to be the case where someone would choose FHA if they're putting 20%
Like, I could see maybe if somebody got an inheritance or something, but their own credit wasn't as good, or they debt to income, maybe that would be a solution there.
Yeah, it could be. Maybe they sold a house recently and now they have funds to put down, but they have some blemishes on their credit, past mistake that won't allow them to get into a competitively priced conventional. An FHA loan can be that option. And then in that situation probably is a starting point. As we mentioned, get in the door with this and then refinance it to conventional down the road.
We were just talking about something before we got on, that they're like assuming that they can't have a loan because of things that happened in their past. And like an educated person. And I think this is what I think with all these loan products, people, I think they always assume conventional, 20% down, need good credit. And I don't understand why the public maybe doesn't even know about this product so much. Maybe we as agents and lenders haven't done as good a job. I don't know. Like, do you find that people, like, they really think, all right, it's good credit, 20% down, conventional, and then start thinking about buying?
I would say yes. For the first two, good credit and 20% down.
Yeah.
From my experience, as someone who knows conventional or FHA or WIDA probably has gone through the process before.
Yeah.
But a first-time buyer, it's very prevalent. The thought of, I need to get more to save down, or my credit isn't perfect, so I have to wait. Something interesting that was implemented in the last few weeks is on conventional loans, pricing actually improved for those with less than perfect credit. So something interesting that it may actually serve somebody better we're kind of getting off topic of the FHA here, but it may actually serve somebody better to apply and get a mortgage for a conventional loan now with a 660 credit score versus waiting until it's a 720 credit score.
Oh, interesting. And that's why I think, like if your lender is not talking about different options and analyzing different things, that maybe you need to, search a little bit more, right? Because I know like when I work with TJ, it's not just like, okay, we're just going to use this product. It's like, what is the right product to use, and knowing all the facts. Mm-hmm. So let's talk about a strategy. Like I think, what is some strategy that, maybe we have somebody who wants to get into investing or that. How can FHA work for them?
Yeah, the FHA product is really great for someone who is wanting to maybe be a first-time landlord, that they're thinking about buying a duplex and renting out one of the units. It can be leveraged in such a way where they only have a low down payment, still that same 3.5%. However, they could then, after being in the home for a year, they could buy their next duplex, as long as it's a bigger, nicer, better duplex. Or what most commonly is all right, I have my duplex, now I'm going to buy a single family home and keep that duplex as an investment property. So an FHA allows that person to get in with a lesser down payment. Remember, if they were buying just a traditional duplex with a conventional loan, they would need 15% down. So they could get that duplex at 3.5% down. There is a requirement that they have to occupy one of the units, so it can't be an investment property when taking out the loan, and they have to remain in that home for 12 months. But after a year, that individual is free to go and buy a different property and retain that FHA loan on that property that is then turning into an investment property and keep that rental income coming in from 2 units.
And then when they're going to buy say they're going to buy a home, assume, so the rental income, does that also count toward like their income as for the next loan they're getting?
Absolutely. So if there's current leases on that investment property, then those lease amounts, the monthly rent amounts, can be included in rental income. If it's a vacant unit, then the part of the appraisal process is the appraiser will provide a fair market rental value. And that rental income can be used. There's a calculation, so it's 75% of the monthly rent from the units can be used, and that 75% simply builds in the vacancy average that's expected. But yes, somebody has the duplex, they're looking to buy another property, another home, they can use the rental income from that duplex and qualify for a better mortgage for the next loan.
What if they wanted to use income from both, but they had been living in one? Do they have to, if they moved out, with their parents or whatever for a few months, that would be the only way? You can't live there and say, well, I'm going to rent both of them. Do you need proof of someone living there?
No, you would not need proof of somebody living. So if I'm understanding your question, someone buys a duplex, they're living in one unit, renting out the other, and then they're deciding, I want to buy a home. I'm going to rent out the unit that I've been living in. They don't have to vacate that unit. As part of the process, that appraiser would identify that unit's average rent, given market conditions, and that expected future rent can be used and leveraged for the purchase of the next home. So no, they don't have to move out of the property and find
right. Give proof of income for a few months. Be homeless because it's going to work for you. But you can only use the FHA on one loan. Is that correct?
You can only have one FHA loan, an active FHA loan, one at a time. In most situations, there are some caveats, but it's very rare. So most likely, someone would have to, if they're looking to buy the next property as an FHA loan, they would have to refinance their current property out of an FHA into a conventional loan, or it could be a VA loan. So they have to refi out of an FHA loan to be able to purchase the next property.
Can you have other products that are kind of backed by the government? So could you have an FHA and a VA or an FHA and a WIDA? Absolutely. Or does it have to be conventional? Okay, you can.
Yeah, absolutely. Yeah, each individual product would have limitations on the number of active loans you could have at a time, but by all means you could have an FHA and a VA.
So that made me think of one more question. So I have a client who will be using an FHA loan, but then they were thinking for their next loan to use an FHA. is that possible, do you think, or how would that work together, or was that not probably going to work together?
So that would mean they would, before applying for their next loan, they would have to refinance their existing loan out of an FHA product.
Okay. So, and what if they did it the other way around? Could they do FHA first and then do VA on their second property?
Yes. Yeah, absolutely.
So that would be the better way to do it. If you know you want to use your VA and you want to have a rental property, do FHA first and then VA?
Yes.
Okay.
Yes, that definitely is a wiser choice.
Okay, got it. Okay, well, thank you. I think those are really good. They answer a lot of questions that people have with FHA loans. So a fun note on the end. TJ and I were talking about Roger's leaving, and TJ noticed some similarities between that. So why don't you tell me what you noticed?
Well, I saw some comments on Twitter post yesterday, but so when Favre was traded, it was 2008. There was a first-round quarterback who had been sitting on the bench for 3 years. Fast forward 15 years, now the exact same thing. Love has been on the bench for 3 years, first-round quarterback. But also, what else took place in 2008 that is fitting to our conversation? Well, we were also in a recession, and we were also in a housing crisis. So the best way I saw was like time is a flat circle. We are back to where we were 15 years ago.
If we would have just asked TJ like 2 months ago, or maybe last month, and there's a recession, we didn't know when that Rodgers was leaving. And wait, did Favre first go to the Jets, or did he go to the Vikings first?
He got traded to the Jets. It's
oh my gosh,
cookie cutter copy of what took place.
I know. I saw a funny meme on Twitter, like it was like Favre saying like he stole some meme like he's doing my same music bar, like same notes, same bar, saying everything. Interesting.
Hopefully the future for Rodgers is a little different. By the way, hopefully he doesn't make it to the Vikings and doesn't have major scandals 10 years down the road.
Right. Because I just feel like he might not have been forgiven as much as Favre. Like, everyone, Favre's had all those things, and it's still like, oh, he's still beloved.
Yep, absolutely.
Rodgers, if you make those mistakes, I don't know. Well, thank you. And so TJ and I are talking. Maybe we'll hop on next week when the Fed comes out with whatever they do with the rates, and just give you a quick update then, so we don't have to wait in between. But thank you, TJ. I really appreciate your time. So TJ is with Guidance Mortgage. If you have any questions, we'll have his contact information at the end of the screen here, but we really appreciate your time.
Thank you, everybody.